What is risk management? Risk management is the process of identifying, assessing and controlling risks to ensure the protection of assets. Risk management is an interdisciplinary field that includes finance, management, statistics, psychology and economics. Risk management is a continuous activity that involves analysis, identification, prioritization, response plan implementation and evaluation. Knowledge gained during a project. ABCs of risk management. A is for avoidance. Risk avoidance involves eliminating or avoiding a particular risk altogether. This may involve avoiding certain activities or situations that pose a risk to the organization, or choosing alternative strategies or solutions that do not involve the risk. B is for black swan. A black swan event is a rare and unpredictable event with severe consequences, such as a natural disaster, economic collapse, or major technological disruption. Black swan events can have a significant impact on an organization's operations, finances, and reputation, and effective risk management strategies should take into account the possibility of such events occurring. C is for control. Control refers to the process of implementing measures to manage or mitigate risks. Control measures can include policies, procedures, technology solutions, and other strategies to reduce the likelihood and/or impact of identified risks. Effective risk management requires the implementation of appropriate controls to manage and mitigate risks. D is for diversification. Diversification refers to the practice of spreading investments or business activities across different areas or markets to reduce risk. Diversification can help to minimize the impact of market or industry-specific risks and provide a more stable revenue stream. E is for estimate cost. Cost risk management is the process of identifying, assessing and monitoring the potential for loss due to unexpected changes in costs. In addition, it also involves forecasting future costs, both for existing and new projects or programs. F is for financial risks. Financial risks have to do with the financial position of an enterprise and how it can be affected by external events such as changes in interest rates, market movements or currency fluctuations. G is for geopolitical risk. Geopolitical risk refers to the risk of economic, political, or social instability in a particular country or region. Geopolitical risks can include factors such as political unrest, terrorism, war, and changes in government policies or regulations. H is for hazard. A hazard is a potential source of harm or danger that can cause injury, damage to property, or other negative consequences. Hazard identification is a critical part of the risk management process, as it helps organizations to identify potential sources of risk and implement appropriate controls to manage them. I is for insurance. Insurance is a risk management tool that involves transferring the financial risk of a potential loss to an insurance company. Effective insurance risk management involves identifying potential risks, selecting appropriate insurance coverage, and regularly reviewing and updating insurance policies. J is for jurisdictional risk. Jurisdictional risk refers to the potential risks associated with doing business in a particular geographic location or jurisdiction, such as a country or region with a less stable political or legal system. Effective jurisdictional risk management involves identifying potential risks, conducting thorough due diligence, and implementing appropriate risk management strategies, such as diversifying operations across multiple jurisdictions or developing contingency plans for potential disruptions. K is for KPI. Having reliable metrics or key performance indicators, KPIs, in the field of information security is a prerequisite to building a successful security program. Measuring operational efficiency, costs and benefits has always been a concern for managers, and information security is no exception. L is for loss. A clear understanding of the nature of risk and how to control it. When companies lose their ability to manage their risks effectively, they are often left scrambling for ways to compensate for these losses. Risk management also includes managing the consequences of risks. M is for mitigation. Mitigation refers to the process of implementing measures to reduce the likelihood and/or impact of identified risks. Mitigation measures can include policies, procedures, technology solutions, and other strategies to reduce the potential impact of identified risks. N is for negligence. Negligence is a risk that arises when an organization or individual fails to exercise reasonable care or caution, which can lead to injury, loss, or damage. Effective risk management strategies should include policies and procedures to prevent negligence and mitigate the potential impact of such risks. O is for opportunity cost. Opportunity cost refers to the potential cost of foregone opportunities, such as choosing one investment opportunity over another. Effective opportunity cost management involves identifying potential risks and opportunities, analyzing trade-offs, and making informed decisions that maximize potential benefits and minimize potential costs. P is for product liability. Product liability refers to the potential legal and financial risks associated with the manufacture and sale of products, such as defects, recalls, or lawsuits. Effective product liability risk management involves implementing appropriate quality control measures, conducting thorough testing and validation, and providing clear instructions and warnings to customers. Q is for quality requirement. The quality requirement in risk management is the extent to which a company's products and services meet customer needs. To manage risk effectively, it is important to have a detailed understanding of all relevant factors. R is for resilience. Resilience refers to an organization's ability to withstand and recover from potential risks or disruptions, such as natural disasters, cyber attacks, or other crises. Effective resilience risk management involves developing contingency plans, establishing communication protocols, and maintaining backup systems to minimize the impact of potential disruptions. S is for strategic risk. The current and prospective risk to earnings or capital raising from adverse business decision, improperly implemented decision, or lack of responsiveness to industry changes. T is for targeted risk. The term targeted risk can be defined as a specific and measurable objective that has been identified by a business unit or division to ensure its long-term viability. It is determined based on an organization's risk appetite and tolerance with consideration of the balance of risk/reward and cost/benefit to minimize threats and maximize opportunities within available resources. U is for uncertainty. Uncertainty refers to the potential risk of financial loss associated with unpredictable or unknown events, such as changes in market conditions or unexpected disruptions. Effective uncertainty risk management involves identifying potential risks, developing contingency plans, and regularly monitoring and reviewing market conditions to mitigate the impact of potential uncertainties. V is for value at risk. Value at risk, VAR, is a measure of the potential loss in a financial portfolio. The VAR calculation is based on historical data, and it provides an estimate of the maximum loss that could occur in a portfolio over a specified time period. W is for wealth preservation. Wealth preservation refers to the process of protecting and preserving an individual's or organization's financial assets. Effective wealth preservation risk management involves identifying potential risks, implementing appropriate risk management strategies, and regularly monitoring and adjusting investment strategies to manage potential risks. X is for expected value. Expected value can be calculated for any type of financial asset, example, stocks, bonds, and options. Expected value has two components: the probability of distribution of possible outcomes, and the mean or average outcome. Y is for yield risk. Yield risk refers to the potential risk of financial loss associated with changes in the yield or return of an investment, such as a bond or stock. Effective yield risk management involves identifying potential risks, diversifying investments, and regularly monitoring and adjusting investment strategies to manage the impact of changes in yield or return. Z is for z-scores. Z-scores are measured in standard deviation units. It is a very useful statistic because it allows us to calculate the probability of a score occurring within our normal distribution, and enables us to compare two scores that are from different normal distributions.